Hey, if you're looking to create a set of financial projections for a small business acquisition, then you have come to the right place because we have built a financial projection model that's built specifically for small business acquisition. So if you're looking to get maybe an SBA loan or raise capital from investors to help support the acquisition, this template's going to be a good fit for you. I'm going to walk you through how to fill it out. We're going to put a link in the description of the video below so you can grab the template and follow along. And also as a thank you, if you stick around to the very end of the video, as our thank you for watching a video all about a spreadsheet, we're going to give you access to a discount code that you can use to take a discount on this particular template. Before I dive into the details, just a little bit of background on me. My name's Adam Huxema. I'm the co-founder of ProjectionHub. And before starting ProjectionHub and helping folks through the financial projection process, I was an SBA lender. I spent 12 years as the executive director of an SBA lender called Bankable. We made over 1,500 SBA loans during my time there. And really, I bring the kind of lender perspective to filling out a set of projections. And so that's really the focus of what I'm going to be talking about here. And as I go through this template, it is relatively detailed. There's kind of a lot of flexibility, but it also makes it a little bit complex. And so, if you're in it and you're like, you know what, I have more money than I have time to deal with this, and I'd just like someone to do this for me. You want to, give us the seller's financials and their, historic financials, and then, tell us about your plans and acquisition price and that sort of thing, and want us to fill the template out for you based on your plans. We are happy to do that. You can reach out to us at support@projectionhub.com, and we do provide a service there. So if you find yourself frustrated with all the details here, let us know, and we can certainly help with that. Okay, let's go ahead and dive into how this template works. Okay, so I'm starting on our at a glance tab. So this is after you have finished putting in all the assumptions of the acquisition, historical financials from the seller, and then kind of what your plans are for the business going forward. You're going to get this nice kind of profit and loss at a glance, some key ratios. You're going to see your debt service coverage ratio, which is going to be really key here in terms of what a lender is going to be expecting, and we'll get back into that in more detail here. But you're also going to get a 5-year income statement summary, 5-year cash flow summary, 5-year balance sheet summary, and then an income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. And you're also going to get a distributions tab. So this would allow you to kind of model out, what if you sold the business in, let's say you sold the business in year 5 at 3.54 earning multiple of earnings. The model is going to look at what your EBITDA is in that sale year and kind of give you gross sale proceeds less your outstanding debt to give you a net sale proceeds number, and ultimately allow you to calculate based on the investment you put in what's your internal rate of return look like on that acquisition based on those sale assumptions. So I am going to walk you through how to fill this out. There's actually 2 versions. So when you purchase this template, you're going to have access to 2 different versions. I'm going to walk you through the non-seasonal version first. I would say this is the easier version to use. The seasonal version has an extra layer of complexity that I'll walk through, but where you would want the seasonal version is if your revenue and your expenses are very seasonal in nature. You want to be able to put in assumptions around that seasonality so that your projections, when you present that to the lender, the last thing you want to do is present a very seasonal business, a lawn care business that has revenue exactly the same, divided equally among the 12 months. So that wouldn't make any sense for a lawn care business, for example. So there is use cases for the seasonal version. I would definitely say if you can get away with the non-seasonal version, there's just less inputs and less complexity there. And I'll mention again, if you get into this and you're like, I just want to give someone my story, my assumptions, the seller's financials, and have our team fill it out for you, we're happy to do that. So always reach out to us at support@projectionhub.com. Okay. I've given that caveat. Now let's go ahead and dive into how to fill this out. So we're going to start on our general assumptions tab here. We've got our company name. We've got what projection start year. So what year do you want the projections to start? So we're going to set that to 2025. We are looking at a proposed acquisition month of September 2025 here, and we want the financial reports to start on the same date as the acquisition. So this is going to probably be the most common scenario if you're presenting to a lender. You're going to want your income statement here to start. You want month one to be month one prior to acquisition. Now there could be some scenario where potentially you'd say, actually we want to be able to show the financial reports from January 1st. So the way that's it's just gonna look different, and so you would see now the report actually starts in January, but it's pre-acquisition, so you don't get any of the data. You're not going to see any of the data because you didn't own the business then, right? And so the way that will then work is just show partial year, and this is also important on this annual summary. So the way that changes up the annual summary, you'll notice this is for the calendar year ended 2025, but you've only owned the business for a handful of months, only 4 months. So your revenue is going to look way lower than the next year because it's not a full year, and so just keep that in mind. I think generally speaking, especially if you're looking at an SBA loan, you're going to want to start the financial reports in the same month that you acquired the business, okay? All right, so same thing so filling out this current asset and liability section, I would typically say you want to set this to be as of the month of the sale. And what you're doing here is entering in any accounts receivable, inventory balance, or accounts payable balances that are kind of coming with you as part of the acquisition. So a lot of times, as of the date of the acquisition, all accounts receivable as of that date is going to go to the seller. So you're not going to get to collect any of that. And all accounts payable as of the date of the sale, the seller's responsible to pay. So usually you kind of start out with zeros here. You probably will have some inventory that you're acquiring if the business has inventory. But probably accounts receivable and accounts payable will be zero. Now, sometimes there may be a situation where the way you've got the deal structured is, you as the buyer will get to keep the accounts receivable. So as of the date of the sale, let's say there's $45,000 accounts receivable, and that's going to come and be paid out to you post-acquisition. So that's the way we've got this actually set up right now. So that's what you want to put in there. And then this is the estimated days sales outstanding. So this is the number of days it takes to get paid. So if you sell an item today, it takes 45 days to get paid. That's what you'd want to put in here. This is our accounts payable assumption, the same assumption here for the accounts payable. So how many days does it take you to pay your bills after you incur the expense? Now on our inventory balance assumption here, what I want to point out is you'd put in the inventory balance that you are acquiring, and then this projected inventory carried as a percentage of monthly cost of goods sold. So we set this as a percentage of sales or a percentage of cost of goods sold so that it scales with you. So as the business grows, your inventory that you're carrying is going to grow kind of in lockstep with that growth of the business, okay? So that's what the assumption is there. Now let's get into debt and equity. So loans prior to acquisition. So let's say the business has currently an SBA loan, $150,000 balance, and let's say this is going to get paid off by the seller in the acquisition. So you're not assuming this debt; it's going to be taken care of. The seller's going to take care of that, pay that off with the proceeds of the purchase. But you could still go ahead and put in terms if you want. That's kind of irrelevant since it's going to be paid off in the acquisition, but you could select, you could have an assumption where it's not paid off in the acquisition and you are assuming this debt, and then you'd be paying on it based on these terms. All right, so new loans for or after the acquisition. So here, let's say we've got $1 million purchase price. Okay, so I've got $1 million purchase price. Let's say we're going to do a seller's note for $50,000, and $50,000 is going to be used for the acquisition. and that origination date is the date of the sale, so it's the same date as the sale date, with a first scheduled installment on 10/1/2025. Now, so in this example, we're not putting the seller's note on standby. We're going to start paying it right away. Now, if you wanted to say, no, it's going to be on standby for 2 years, for example, we could change the first installment date to 10/1/2027 as an example. You could set the interest rate and the term on those on that loan. Now, let's say we've got an SBA acquisition loan for $900,000. We're using all $900,000 for the acquisition. Origination date's the same as the sale date. First installment the next month. 10% interest rate over 10 years. And then we have our equity. So the equity investment at the acquisition, let's say we're bringing in $100,000. We're using $50,000 of it's going to be for the acquisition. It's going to go to the seller, right? So that's what you see up here, kind of the use of proceeds. You've got $950,000 in debt, $50,000 in equity that's going towards the seller for that $1 million purchase price, and then you're left with $50,000 cash in the bank post-acquisition. Here's where you can enter in the assets that you are acquiring. So these would be the fixed assets that you're acquiring. Let's say you're acquiring a building, some equipment, some furniture. You'd want to put in the estimated fair market value from the seller's balance sheet here. You can put in the remaining useful life. And then here you can actually put in new equipment. So let's say you said, the plan is once we acquire the business, we are going to, upgrade our equipment or get an additional truck or additional machine or whatever that might be. You could set, projected future purchases. So this is after the acquisition and, month 4, April of the following year. And we can set a purchase price and life expectancy there. Now this section is going to calculate goodwill based on all of your assumptions. So typically, when you're acquiring a business, you're going to have a value of the assets that you're acquiring. So here's kind of the value of the assets we're acquiring is $705,000 based on the value of the fixed assets, the accounts receivable, and the inventory. But then we are also acquiring some debt with the accounts payable that we're going to be taking over. So the net value of the assets is $660,000, but we're paying a purchase price of $1 million. So the difference there is your goodwill, and that's going to be added to the balance sheet automatically. All right, let's go to the historic data input tab here. So let's say, we are looking to close this loan as of September 1st, 2025 in this example, but as we're doing the modeling here, let's say we only have 4 months of 2025 financial data so far because we're planning ahead. And so we're modeling this out with only 4 months of actual data. Now, you have some different options here. You can select from this drop down. It says for projections, consider the historic base to be. And so basically what this is doing is saying, what do we want our baseline for the projections to be? Because in the next tab, we are going to take that baseline and apply a growth rate to it. So we want to say, how do we want to think about what that baseline should be? So there's a bunch of options here. You could take the prior fiscal year as the base. You could take the prior year and the current year average. You could take the average of all available years, or you could annualize the current year. So I'm going to, in this case, annualize the current year and use that as our baseline. So I'm going to go ahead and put in, I've got 3 different kind of revenue categories. I'm going to put in historical financial information for the last few years. You can put in as many or as few years as you'd like. You don't have to put in all 4 years, but you can. And then I'm going to put in the first 4 months of the current year. So here's $55,000 is our revenue for this line item for the first 4 months of the year. Then I'm going to do the same thing with expenses. So I've got our different expenses here, putting in historicals, and putting in a number in for the first 4 months of the current year. And then here we can add add backs. So if you're trying to kind of get to a seller's discretionary earnings number here, you can add in some add backs like the seller's salary, or maybe here's a one-time revenue. This would be actually a negative add back. So if there was kind of a one-time revenue event that isn't recurring, we should actually put that in as a negative add back here. So this ultimately helps you calculate what that seller's discretionary earnings looks like. All right, let's now go to our revenue input tab. So it is going to pipe in the revenue line items from your historic input tab here, right? So it's piping these in. So we've got revenue line item 1, 2, and 3, and you can change the names to those. And then you're going to categorize these. And so let's say up here we set our revenue categories. So we can set up to 4 different revenue categories. And maybe this could be product sales, and this revenue category 2 could be services, for example. And so we could then categorize. And one thing to note, if you change the name, so if we said products and services, you'll notice everything gets zeroed out, right? Because now we need to come back down here and we need to select the new category name. All right, so now we've got our products and services set up, and this is our annualized current year revenue, okay? Because we said we wanted to use the annualized current year as our baseline. So here's our baseline now. So we assumed, we had 4 months of data. Let's assume we did the same amount for all 12 months. This is now our annualized current revenue. And now we can apply a growth rate to that. Okay, and so actually what we're doing here in the first year, we're saying, actually we have 4 months of data and we want to annualize that as the baseline, but we actually think we're going to grow a little bit faster. So we're going to actually increase we're going to set an annual growth rate of 5%. So 5% greater than what that annualized current revenue is where we think we're actually going to end up for the year. So our end of year revenue here is projected to be 173,250, which is a 5% increase over this 165. Now you can set an annual growth rate, or if you wanted to say, I don't really know I don't want to put in a percentage growth rate. I just want to say this year's going to be 90,000. This year's going to be 120,000. This year's going to be 300,000. You could just manually do that. You can certainly do it that way as well. And then one thing I'd like to point out, and this is important for you if you're getting an SBA loan. So one of the biggest things the SBA is going to be looking for when requiring projections for an acquisition is they want your assumptions. And so what I'd recommend that you do is put in these notes a summary of your assumptions. So if you think you're going to grow revenue, 15% in the first full year of operation under your ownership, how are you going to do that? Revenue to increase 15% based on new product offering, or something like that, right? And, give some context of how you're going to do that, okay? That's going to be important when you are applying for an SBA loan. They're going to ask you for your assumptions, and that's what the intention of this notes section is, to be able to provide assumptions on a line-by-line basis. All right, so we've got the same thing now to do for our expenses. We can put in our various categories of expenses, so cost of goods sold categories and our operating expense categories. We've just put in a few example categories here. And then you can put in the actual line item. So just to be clear, when you get the seller's financials, their income statement may have 40 different expense line items on it, right? So you could add, you can see there's many, many rows here. You could add all 40 expense line items down here in this section. But what we want you to do is select a category, one of the 15 categories for each of those line items. So we're trying to consolidate some of that to just to keep the financial statements clean, because when we look at our income statement, we are only going to show the category names here. Now, one thing I want to point out while I'm here is that you'll notice this goes from row 27 to row 43. Now there are some hidden rows, so to unhide those, we highlight, right click, and click unhide. We can see these unused expense category rows. So if I wanted to say, here's another expense, Adam's salary, and let's just categorize this one as Adam's salary now. And if we come back here, now we see Adam's salary is showing up in that row that was, once hidden. So that's how you can kind of add categories, and then when you first add them, you're not going to see them here. You're going to need to unhide those rows, so keep that in mind. Okay, once we have entered in our expense categories here and selected the category for each expense line item. Now these again are going to be populated from your historic data. Okay, it's pulling from the historic data, and so you should just need to categorize those. Now we're going to come over here to our entry method, and there's a couple of options. We can either set an annual growth rate, so this is similar to our revenue, so we could set an annual growth rate and say this expense line item, this was the baseline or the annualized current year, and we are going to grow at 4% a year. So you could set a manual entry here and then just set what that should be going forward. Now the thing that is different about the expenses than from the revenue is that you can set an expense as a percentage of revenue. And you can set what revenue type. So you could say this expense line item, this particular expense line item, is going to be a percentage of product revenue. And this expense line item is going to be a percentage of service revenue. And what this will do, and that maybe this expense line item is a percentage of total revenue, okay? So the model will automatically calculate in the past what percentage of revenue was this expense line item, okay? So this is just calculating that for you, so you can see historically this line item was 9.61% of product revenue, okay? And this line item was 7.23% of total revenue. And so what I typically do then is I come in here, I just copy this, highlight, copy, and then I come in here and I right click, and I'll just paste values, and then I'll probably just drag this across. So what I'm doing here is I'm setting these expense line items to continue to be a percentage of revenue. So as revenue grows in those future years, rather than having this expense line item grow at a certain growth rate, it's just going to make sure that it stays in line at that same percentage of revenue. And so that's a good way to basically in the notes, again for an SBA lender, to say expense assumed at same percent of revenue. And the underwriter is going to understand, okay, we're just kind of keeping things the same here on a percentage of revenue basis. Okay, so that is really it. So once we've done all of that, we're going to come back to our at a glance here, and we're going to see the first thing I would always look at is our debt service coverage ratio. So if you're looking for a loan, if you're looking for an SBA loan, kind of the very bare minimum rule of thumb is a debt service coverage ratio of 1.25 to 1. And what that means is that you need to have $1.25 of profit or cash available to cover your debt service. So $1.25 for every dollar of debt service that you have. So if your principal and interest payments on your loan are going to be $100,000 a year, you should have $125,000 of profit to hit that 1.25 debt service coverage ratio. Now that's kind of the bare minimum. A lot of lenders, and again depending on the industry and the deal, they're going to really probably want that to be even higher, but that kind of gives you a good rule of thumb of what the bare minimum should probably be. And so if your debt service coverage ratio is less than that, something's got to give. You got to increase revenue, you got to decrease expenses, or maybe you got to borrow less. So you might have to come back to the seller and say, hey, look, this doesn't cash flow for an SBA loan, and we're gonna have to borrow less And so we need you to lower the purchase price, or we're going to have to raise more equity, or we're going to have to put more on a seller note on standby, or something like that. Something's got to give if that debt service coverage ratio doesn't pencil out. Okay, so that is really it. I think the other thing I would just point out is I'd always make sure to look at the cash flow statement, the monthly cash flow statement, and take a look at this to make sure cash never goes negative. And that's an important thing to be aware of. So make sure cash never goes negative, and look at your debt service coverage ratio, and I think that should put you in a pretty good spot. Now I want to look at one more thing here. I want to look at our seasonal version, as I had mentioned. So the difference between the seasonal, non-seasonal is in the historic data input. We're going to do the same thing where we're going to put in our historical numbers here, but then we need to come up with the seasonality section. And so what I'm going to do here is I'm going to select a year. I'm going to say, okay, I want to do this for 2024 because I've got a full year of data for 2024 here. And I'm going to put in my revenue percentage for each month. So what we're saying here by saying 10%, we're saying 10% of this 145,000 for 2024, 10% of that revenue happened in January, 5% happened in February, 5% in March, right? And so we can see, we can enter in these different percentages. Maybe November and December for your business are the big months, and so maybe November, December, January are your biggest months, and so you can see how we kind of weighted that towards the end of the year. Now you want to make sure that this adds up to 100%, right? So don't add in more than 100% on the percentages here for each month. So we set this up as an example, and you can do the same thing for your expenses. You can say follow this seasonal pattern. And so what I really did is I kind of set this example right here for this first line item. I just copied and pasted it down here and said, all right, expenses, just follow that same seasonal pattern. Now, if you don't enter in anything here on the expenses, so if there's an expense that doesn't follow a seasonal pattern, which is, I'm sure you're going to have expenses that are the same every month. So if it's the same every month, you could either put in the same percentage every month, or if you just remove that altogether, the model is going to automatically assume that it should just take the expense line item and divide by 12 and just distribute it evenly across the months, okay? So that's how that's going to work, and the revenue and expense input is going to follow, the same as the non-seasonal. So the difference here is, though, when you put in these growth rates, right, the projections are going to follow that seasonal pattern. And so we can look, if we look at our monthly income statement here, let's just take a look at this, revenue category 1. It's not the same every month, right? It's following this seasonal pattern. And one thing to note here is that we'll notice we're starting in September. And so remember, November and December were our busiest months. I might have been expecting them to show up over here, but we got to remember our dates. So November and December are actually, month 3 and 4 here, because we acquired the business in September. Okay, so you can see November, December, the biggest months here, and then slowing down. And you'll see the expense line items following the same seasonal pattern as well. And then some of the expenses where you didn't apply a seasonal pattern, like the salary section, is the same every month because we didn't apply any seasonality to it. Okay, so that is really how the seasonal version works. You can kind of see the seasonality trends there, but I think that is really it. So I know this is a lot, and so again, just want to reiterate, we're here to help. Feel free to reach out to us at support@ProjectionHub.com if you have questions, you want us to review what you put together. And again, we're happy to help fill out the model for you. We can take your seller's historical financials, get that into the model, get your plans into the model and really get it built out and make sure that debt service coverage ratio is making sense and all of those things. So as a thank you for sticking around to the very end of this long video, we are putting a link in the description of the video below to a form. You can fill out that form and get access to a coupon code to take a discount on this particular template. And if you found this to be helpful at all, please like and subscribe to our channel. We're going to be putting out more content about small business loans and acquisitions and modeling those. And so that really helps get the word out about our channel. And we would appreciate any support you can give us. All right, I think that's it. And again, reach out if you have any questions. Thanks.